Good morning, good afternoon, good evening. Welcome to the BP High Community Training, where we teach you Forex, how to download dollars, how to generate dollars to your bank account, to your wallets with just your mobile phone, earning over $1,000 monthly from the financial market. So this is the Forex Profit Hack course, where we teach you about Forex. Okay, for those meeting me for the first time, quick introduction. My name is Ejiro Genelgos. I am an independent gentleman trading Forex. I'm a speaker and a coach, a financial growth expert. I am also a partner to more than 5 reputable Forex brokers globally. And I have been involved in organizing and speaking in several investment seminars since 2016. You can call me PO Money, and I'm the king of residual income. As you can see, these are photos of me teaching people how to earn from the financial market and how to grow their income. Okay, so this video will focus on the part one, the basics of Forex. Unlike the usual training out there before now, where you have to learn Forex for years before you can start trading, 4 years. No, this video will focus on simplicity. We have simplified the training into 4 hours or less. Okay, and this video training will focus on teaching you and helping you to learn forex trading skill in the fastest possible time. Okay, so let's get into it. Let's talk about the basics and the fundamentals of forex trading. Introduction to forex. Now, what is forex, you might ask? Forex is an acronym for foreign exchange. So the word foreign exchange, okay, so we took at FOR from foreign. Okay, we took out FOR from foreign, and we took out EX from exchange. So when you hear the word Forex, what it means is foreign exchange. And Forex is an international currency market which have daily deals worth over $6.67 trillion. So the forex market is the process in which a nation's currency is being traded for another at a mutually agreed rate. The forex market can also be seen as a global market that allows one to trade two currencies against each other. So you might ask again, what is being traded in the financial markets, in the foreign exchange market? It is simple: money. Okay, forex trading is the simultaneous buying of one currency and selling of another currency. So basically, what we are doing here in forex is we are here to make money. Okay, and we must make this money. Now you must know that forex in forex the trade occurs between two different currencies at the same time. Okay, because one currency is being bought at and another is being sold at the same time. Now these are the most common currency pair. So forex deals with pairs. When we trade forex, it works with pairs. That is to say, you cannot trade forex with just one of this particular currency. You cannot pick out euro, okay, and say you want to trade forex with just euro. It's not possible that way. It happens in cryptocurrency, where you can pick a particular crypto, for example, Bitcoin, and then buy the Bitcoin. Okay, but here, when it comes to forex, we trade in pairs. Okay, you work with euro tied to the US dollar, GBP tied to the US dollar, USD tied to the Japanese yen, and that is how it is. And these are the most common currency pairs. Okay, now when we look at a currency pair, one thing you must know is this: on a currency pair, there is a base currency and there's a quote currency. The base currency is usually the first currency, and the quote currency is the second currency. When does the forex market work? The truth is, the forex market is open 245, okay, which is 24 hours a day, 5 days of the week, Monday to Friday. Now, these are ways we can trade Forex. If, for example, you traveled from one country to another country, let's say, for example, you're traveling from United States of America to Nigeria, or you are traveling from Nigeria to United States of America, then when you get to the country, you have to find a currency booth at the airport and then exchange your currency, the one you have in your wallet, to the country you are visiting's currency. For example, you are leaving Nigeria, so while you are leaving Nigeria, you have Naira. Okay, you have Naira. When you get to United States of America, you can't spend Naira there. What do? You exchange your Naira for what? For dollars. And by doing that, you are participating in Forex. So when you get to the exchange booths, you are going to notice that there are screens displaying different exchange rates for different currencies. When we talk about exchange rate is the relative price of two different currency of two different countries. Okay, the relative price of two currencies from two different countries. That is the exchange rates. Okay, so when you get there, you look at the exchange rates and then you do your exchange, and then you are given an equivalent to the naira that you have. When you do this, you have participated in Forex. Another way people trade Forex is this. Take for instance, a company trying to buy goods from another country. For that to happen, this company will have to obtain the local currency of the country they want to buy the goods from. For example, if let's say Ford company from United States of America wants to buy machine parts from Germany, they cannot buy these machine parts from Germany using the dollars. What do they have to do? They have to first exchange their dollars to euro, and they are given the equivalent of what? Of euro. And they can use this euro to go do what? To go buy this currency, these machine parts. By doing that alone, they have participated in Forex. Okay, there's a difference between you and I and these big companies in relation to Forex. Now, what do I mean? Now, these companies like Ford, their transactions, okay, the transaction they do on the Forex markets, their exchange, their transaction they do this in high amounts. The exchange they do it in high amounts. Imagine them coming to Germany to buy machine parts worth let's say $20 million. Imagine the exchange that they are going to be doing. It's going to be a high amount, okay? And this transaction alone is going to move the exchange rate, which is the price. Now we see this as demand of the euro currency because they have their dollars, but they cannot buy goods with dollars. So they are not demanding, they are buying the euro. So when there's a demand for a particular currency, the price of that currency will increase. So it will increase the exchange rate for that currency. Definitely, with a lot of exchange, with a lot of people going to different countries to buy goods, this, that, people exchanging currency for another currency going on globally, then you're going to see price constantly moving every single seconds, every single minute. Price of different currency is always fluctuating. Okay, which is why when you go to the bank today, you see that $1 is equivalent to 600 naira, and then tomorrow you are there, you see that $1 is now 685 naira. This is because activities is happening globally that is affecting the exchange rate of each currency. Now we know that as in any other markets worldwide, the price is determined by the supply and demand. Now if there are many people or many companies that are going to exchange their euro into dollars, what will happen is that dollars is going to rise against the euro. Now let's face some facts here when it comes to Forex. Now Forex is over $6.6 trillion industry. Okay, we should say an average of $6.6 trillion is dropped in the market on a daily basis, and this is the largest market in the world. It's the market that has the most liquidity than any other market. And this market matches buyers and sellers, matches those with excess fund and those with shortage fund. And this is a place anybody can come in, take advantage of this space, because money is just floating in the air and there are a lot of money to be made. Now, you might want to ask, who are the people who are involved in these forex markets? Who are the participants? We have a lot of participants. We have the investment manager first. The number one participant you want to look at is the central bank. Okay, we have the central banks, we have the commercial banks. Okay, we have the exporters, the importers, the tourists, the investors, immigrants. We have traders and speculators like you and I. Okay, we have individual investors, we have the brokers of the forex market who are there, we have the investment manager, we have the hedge funds, we have the multinational corporations. These are the people involved in the forex market. Okay, and this forex market is traded 245. Okay, you might ask, how is this market traded 24 hours? Now the market have what is called session. Okay, the globe is divided into different time zones. Okay, and there are major financial centers in all of these time zones. Okay, for example, we have the London session that opens, let's say, 8 a.m. You know, when it's 8 a.m., banks around the world, they usually open. And in the London section, once it's 8 a.m., the banks will open. And you know, when banks open, people start going there to make transaction. Even large corporations are trying to make payment for one thing or the other. So at 8 a.m. during the London session, the market is open and people can begin to trade forex. So the market runs down to, at this point along the line, New York session is going to open around 1 a.m. for London time. Okay, in London session, when it's 1 a.m., around that time the New York session is opening. So you see that there's an overlap between the London and the New York session. Okay, so along the line, by 4 p.m., okay, the London session will close while the New York section is still on. Okay, and we have the Sydney section. As soon as the New York session is closing, the Sydney session is opening. Okay, the Sydney, which is the Asian session, and together with the Tokyo, they open around this time. And at this point in time, is around about 11 10 11 a.m. in the London session, around night midnight, going to midnight in the London time. Okay, that is when the Sydney is opening. So you might say that, okay, this is ninth, how come transactions are going on? That is because another session is opening that time. The Sydney banks are opening around, this is 8 a.m. in Sydney session, and it spans up like this. So there's an overlap between the Sydney and the Tokyo session, although the Sydney and the Tokyo, they are under the Asian market session. Okay, so you see that the Tokyo ended around this is 12 midnight 12. Okay, this is 4 o'clock. When the bank is closing, the Tokyo banks are closing by 4. When the Tokyo bank are closing by 4, that is when the London bank is opening again in the morning, 8 a.m. Okay, so you see the market is open 245. Okay, the market is always open from Monday to Friday. Okay, so we have the European session, which we know London is the financial capital for Europe. We have the New York session, and we have the Asia session, which comprises of the Sydney and the Tokyo. Now, one thing we need to know is that the forex market tends to be more volatile during times when there is an overlap, like the when we have the London session and the New York session overlapping. We're going to be experiencing a lot of volatility. Why? Because a lot of people are currently doing trading in the London session, and trading is also going on here at the New York session. So whenever you find an overlap, there is more liquidity in the market because we have a lot of active market participants. The question is, what can you trade on the forex markets? Okay, When we talk about forex market, there are different things we can trade. For example, we can trade currencies. When we talk about currency, we're talking about money, fiat money, paper, coin of different countries that is issued by their government, means of payment that is accepted. Okay, so for Nigeria, we have Naira, but right now it's not being traded. Okay, so we have the dollars, the pounds, Japanese yen, different currencies being traded. Commodities like oil is also being traded. And other commodities, we have cryptocurrency, which is digital currency that can be used to purchase goods and services, which use online ledger with stronger cryptography to secure online transactions. So people right now trade crypto, Bitcoin, Litecoin on the foreign exchange markets. Now let's look at two ways people trade forex, and we'll look at the one that we are going to focus on as forex traders. Okay. Now one way people trade forex is called the spot forex. Now what is spot forex? Spot forex is a form of forex trading that involves you buying and selling a real or the real currency. So for example, you can go and buy and hold a certain amount of dollar. So it means you are buying the real dollars and you are holding it. Okay, so you have dollars in your pocket, you have dollars in your wallet, you have dollars kept somewhere in your house. So you are holding the real assets. You are owning the real assets, dollars. Now, if let's say you buy dollars for, let's say, 600 naira per dollar, and you have $1,000, okay, that would be about 600,000 naira, and then you keep this money in your house. If the value of dollar increases against naira, and $1 now becomes 1,000 naira, you can go back and sell this dollar to get back your naira. When you do that, you have participated in what is called spot forex. Now there will be a profit, okay, because now the exchange rate now is now 1,000 naira per dollar, and you have $1,000. So now you're going to be getting back 1,000,000 naira. So that is what we call spot forex. Spot forex means buying the real thing, okay, buying the real currency, buying the real assets. If you've heard of cryptocurrency, you must have heard of spot trading in cryptocurrency. If you've not heard of it, spot trading in cryptocurrency also means the same thing. You buying the real asset, so you can buy crypto, buy Bitcoin, and hold on to it. That is spot. Okay. Now the second type of trading is called the CFDS, which means contract for difference. CFDS, contract for difference. Now contracts Contract for difference is a contract used to represent movement in price of financial instruments. Okay, now in terms of forex, this means instead of you buying and selling large amounts of currencies, instead of you buying and holding currencies in your hand, then selling it later, what you do is you take advantage of price movements without having to own the currency or the asset itself. Instead of you buying crypto and holding it in your wallet, instead of you buying dollars and keeping it in your dollar wallet, in your dollar account, you are not going to buy the main dollar. You are only going to take advantage of the movements of price, the fluctuation of price. You take advantage of it to make profit without you having to own the dollar itself. So people trade CFDs in stock, volatility indices, cryptocurrencies, and so on. So what we are doing here is we are trading the price movement, taking advantage of price movement without buying the real currency. Now, CFDS now provides a unique opportunity. Okay, it makes forex trading very, very unique in the sense that people cannot make profits from selling the particular markets or buying the particular market. I'm going to explain further. So there are two ways we can make money from forex. We can either buy, okay, which is called the long, okay, the long CDF, or we can either sell, okay, which is called the short CDF. Okay, now let's go over it one after the other. So when we talk about long CFDS, which is buy, remember what we are buying is contracts for difference. We are buying a contract. Okay, now this is how the market works. If this is a certain market, you can decide that at this point, maybe for example gold, you may decide to predict if the market will go up or go down. Okay, so you're going to buy a contract. Okay, so when we buy a contract, okay, the question is what kind of contract are we buying? You can say I'm doing a buy contract. So when you buy a buy contract at this point, if the market begins to go up, okay, if the market begins to go up, you are making what? Profits. Now, before I continue, let me make this clear. In Forex, you buy when the market is going up. In Forex, if you buy a particular asset and the price of the asset is going up, you will be making profits. Okay. In Forex, if you sell a particular asset and the price of the asset is dropping, you will be making profits. In Forex, you sell a particular asset when you know that the price will fall. So that after your sell position has been taken, when the price begins to fall, you make profits. Okay, let's get back right in. So this is it. You take a buy trade at this point simply because, or you take a buy contract. You buy a buy contract at this point because you know that the price will go up. Now, if the price is going up, you'll be making what? Profit. Why? Because the kind of contract you purchased was a buy contract. It's like you predicting that the market will go up before it actually went up. But if you take a buy contract here and the market begin to drop, what happens is you're losing. You are losing. And the money you are going to be losing will be in relation to how far the market has dropped from your entry points. So if the market is dropping and you're losing, let's say you're losing $1, somewhere around there, you're losing $2, $3, $4, $5. So if you close the trade somewhere around there, you're only going to lose $1. If you close around there, you're only going to lose $3. Okay, so what you are losing is how far the markets go against you from your entry points. Okay, the same as your profits. If you enter the market at this point, as the market is going up, what you are making is in relation to how far the market went to your direction as you predicted from the beginning, and then you close your trade on profit to bank in your money. So if for example this is good and this is not good, but if for example this is good, or maybe Euro USD, and at this point in time you decided that the market will go up from this point, all you need to do is take a buy trade, and then the market begins to go up your way. As it's going up your way, you are making profit and you can exit the trade at this point, close on profits. So the same happens to sell trade. Now in a sell trade, you are buying a sell contract, okay? So sell trade, okay? When you buy a sell contract at this point, remember the reason why you're going for a sell trade is because you have analyzed the market and you've seen that the market will drop, the market will fall, okay? The price will depreciate, then you go for a sell trade. And when you go for a sell trade, what will happen is if the market is actually going down, you're going to be making what? Profit. But if you took a sell trade and the market begins to go up, you're going to be losing. That is how it works. So if this is a market, okay, and at this point you decide that the market will go down, you take a set trade, and depending on how far it goes, you are going to make a lot of profits. Now there's a concept called stop loss and take profits when it comes to forex. Now this concept is a functionality in the forex market that allows us to manage our account properly so that we don't get to lose our entire money in the forex market, and we don't that is it, we don't get to lose our entire money. Now both stop loss and take profit orders are basically you as a trader telling your broker. The broker is the company that connects you to the market. So you the trader, you are telling the broker when they should help you close your trade, even if your phone is not with you, even if you are not with your phone at the moment, even if you are not paying attention to the markets. Okay, so stop loss is designed to let the broker know that you are willing to risk a certain amount of money on a particular trade and you don't want to risk above that money. So if trade is going against you, then they should close you off that market. Okay, why take profit you is the opposite. Is you telling your broker that you are willing to make this amount of profit and you are willing to allow them close your trade at that amount of profit, and you'll be happy with that amount. If for any reason you are not on your phone and price gets there, they should help you close the trade on profits. Now this is how it works. Okay, if this is Euro USD and the market is moving upward, as you can see, it's going up, and then you decide that the market will go up, you take a buy trade there. Now, when you take a buy trade, what you can do is set a take profits. You can look at the chart and say, okay, I feel that the market will get to this level, and then you set a take profit at that level. Then you can, when you trade Forex, you don't have to focus on your phone 247. Forex is a passive income opportunity, not a active income. That is why you can have a business, have a job, and still trade Forex. So it's not something you have to put on your laptop and put your laptop by the side while you do your business and be watching every minute. No. So you can look at the price, the level in the chart, so where you know that price will get to, and you tell your broker that if price gets to this level 1.11300, they should close the trade on profits for you. So you can go do other things. Okay, so if the price begins to move up, and then when it gets there, automatically the broker will close it on profits. And maybe in the next 4 hours, price has even passed there, or price has gone down below again. When you check your phone, you see that your trade is no longer active. When you check properly, you see that the trade has been closed for you on profit. Your account was $100 before, but now the profit has been closed. Your account is now $120. Okay, the trade has been closed on profit. The money dropped on your account. Your account has increased in value. That is how it works. Now, stop loss is, remember we took a buy trade at that point. We took a buy trade. The market was going up and we took a buy trade. Now, anything can happen in the market because there's what we call plain sheets. Okay. For example, if this is where the market is right now, we don't know what is happening at this point. Okay. So you are making decision and you don't know what will happen next. So imagine that when you took this trade at this point, you may not know what will happen. Although based on your analysis, you've predicted it will get here, but you don't know if it will go down. Okay, so that is why you have to set stop loss. Okay, so if this is the same trade and you took the trade around here, you took a buy trade here with the expectation that the price will get to this level where stop loss is written. Okay, um okay, let's use this line with the expectation that price will get here. Okay, far up here, but like I said, you don't know what the market will do. It may go against you. So you now set a particular level and say, okay, this level, I believe if the price gets to this level, then the price is no longer going up anymore. Okay. I think the price market has changed direction to a sell. It will begin to drop from this level. And if I take a buy trade and the market begins to drop down, the level of how far it drops down will determine how much I'm going to be losing. So if it goes far below, I'm going to be losing my capital. Okay, but I believe with my analysis right now, the market is going to go up. But if for any reason it changes and begins to drop down, as you can see, at first it was going up and then it drops down, it was going up and it was going down. So you say, okay, if the price get to this level, you did not choose here because you believe that if price fall down to this level, you still believe that price will go up. Okay, so you believe price will go up from here, which actually it went up. Okay, but it fell down. You believe that if price even gets here, price will still go up. But at this level, you believe that if price should touch that level, you don't see price going up anymore. You see price going down from that level. So you set this place as your stop loss. Okay, so you put off your phone, you take your trade. As the trade is going on, went up, came down, went up. Once price get there, the broker will respect your order and help you close the trade on profit instantly, automatically. And then when you check, you see that your account that was $100 is now $93 because certain amount of money has been closed on loss. That is how it works. So this is a real life trade on how you can set stop loss and take profit. This is where we took a buy trade. Okay, this is the buy trade right now. We took a buy trade there. I will believe that the price will go up to this point. So remember, this is a blank sheet. We're not seeing what's going on here. We took a buy trade here where we have this green line. If you take it down here, you see that there's a buy button there. Okay, which is the buy alert. information there. So you took a buy trade here and you believe that if price should fall down to this point, it should close on stop loss. You see here, SL, stop loss, stop loss. But if price should go up here and get to this level, it should close on take profits for you. So that is how it works. So you can set stop loss and take profit at the same time. So whatever, whichever the price gets to first, it will activate. If it gets to take profit, it will activate or take profits for you, and then you can analyze the market again and start trading again. Okay. If price gets to your stop loss, sometimes it could be that okay, price is selling, you want to sell immediately with it, or you want to analyze the market again before you enter another trade. But guess what? You can't just go start trading forex with just that information. So we'll need to learn more about forex. Before then, let me give you a quick trader survival rates. You must understand that 100% of those people coming to learn forex or start trading forex, they came here with a dream to get rich quick. Okay, 100% came with a dream. A lot of them, they came here to get rich quickly. Along the line, in 1 month's time, 40% of them will stop trading in 1 month's time. And in a space of about 2 years, 80% of them must have quit forex trading before their first 2 years. Okay, and in a space of 5 years, you will only have 7% of them remaining in the forex trading journey. So if you are starting your journey today, don't look at just today. Look at yourself in the next 5 years. Are you still trading? Okay. Are you still trading in the next 5 years? Some will trade in the first 1 month, they're gone. Some first 2 years, they've quit. They will tell you, not, I'm not trading forex anymore. Okay. And lastly, which is why you see that 99% of the people who are trading forex they lose money, or less than 95% loses money. Okay, then we have 1 more percent of people, traders, who can make profit in the markets. Okay, and they still trade forex even after 5 years. The question is, will you be among this 1%? Will you be among those 5% of people who are still trading after 5 years, who are also making profit from the markets? Anyway, let's take a look at the advantage of trading forex. Now, one thing about forex trading that I love so much is your workspace and goals are up to you. Okay, whatever you want to make is up to you. Where you work from is up to you. You can work from anywhere, from home, from the beach, from the swimming pool, from anywhere. Okay, you can trade forex from anywhere. Again, you can start forex with as low as $50. Before now, people start you have to have $10,000, but right now you can start with as low as $50. People even trade forex with $10, $10. Okay, but $50 is the recommended minimum. Okay, so another good thing about forex is even in times of crisis, the forex market can still be on profits. Okay, people can make profits in times of crisis. Why? Because of what we call the CDF. We saw the CDF recently, contract for difference, allowing us to buy and make profit, allowing us to sell and make profit. So if there's a crisis in a particular country and their economy is dropping, we can profit from that by selling their what? Their currency. Okay. This is not possible in the stock markets. Okay. But in Forex, it is possible. Now you work without stress, with ease. Okay, you can start trading your money with your smartphone and internet connection. If you have a laptop, you can do that. Okay, where you want to trade from is up to you. Whenever you want to withdraw your profit, you can withdraw your profit. It's not as if you are sending your money to an investor. Your money is with you. Your forex trading account, which is your broker account, is like a bank account where you put money and you have access to the money every time. The only difference between your forex bank account and your broker account, please work with recommended brokers. Okay, work with recommended brokers. Now, these recommended brokers are regulated, so it's just like our bank is also regulated. Okay, so the difference between forex broker account and your bank account is that in your bank account you cannot grow your money there, but in your forex account you can put any money there and you can grow it by trading forex and making profits. But you have access to your money just the way you have access to your bank, and you can take money off it anytime, put money anytime. That is how your forex account is, your broker account is. Okay, you're going to be trading with our recommended broker, so you register your account there. Now, one advantage again is that it offers you minimal time commitments, which is 1 to 3 hours per day. It's more than sufficient to trade forex. 3 hours a day, 1 hour per day is more than enough. You don't need a boss. Okay, you are your own boss, and you don't need a office. Okay, and forex is a recession-proof business. It makes you money regardless of whether the economy is up or down. The market is open 245, giving you flexibility. You can build your business from anywhere around the world. You can plan your daily trading routine around your job or your business. You can generate consistent profit. You can make between 5% to 20% weekly or even a month. You can even do 100% profit every month. Some do it sometimes per week, depending on your risk appetite and your how well you understand forex and your skill sets. Okay, now trading either forex, volatility indices, cryptocurrency can guarantee you a life changing opportunity. Now trading forex, volatility, cryptocurrency can guarantee you income for life even after retirement, retrenchment, or you're fired from your job. One disadvantage about forex you need to know is that the risk is high. You can lose your money in forex. You can lose your entire capital. Okay, and forex is not for everybody. If you are not a disciplined person, then stop right here. This is not for you. Okay, stop right here. If you are prone to make rash decision, this is not for you. Then you can go focus on something else outside trading. Okay, if you are too busy that you cannot even have 10 minutes of your time to manage your investment portfolio, then you want to consider trading with a robot or a copy trading. Okay, now what do you need to do now? Right now, you need to start trading forex, start trading CDF. The first thing you need to do is open an account with our recommended broker. Okay, on the resource folder or on the resource link, you'll see our link to create an account with SNES, which is our recommended broker right now. So click the link, create an account with that broker. There's a video after this one which you can watch. That will show you what and what to do, how to go about it. Okay, click the link, create your account, and then download the MetaTrader 4 platform. Then make a deposit to your trading account to get you started. Okay, so that is it. So thank you for being part of this first part of the Forex Profits Arc course from the BPI ecosystem.